Hi everyone, and welcome back to the channel. So you're thinking of getting into multifamily real estate? Maybe you've done a single family house or two, but you want to go big. Well, analyzing a multifamily deal is a whole other game. It's not just about the rent, it's about a close, forensic look at the numbers, the building, and the market. Today, we're breaking down the entire process, from your initial concept all the way to the final decision. This is the step-by-step blueprint you must avoid costly errors and build real wealth. Let's get started. All right, before we even look at a single listing, we have to talk about you. What's your strategy? Multifamily investing is typically an active wealth creation strategy, not a passive income stream. So you need to get really clear on your rules before you find yourself falling in love with a property. You need to figure out your non-negotiable numbers. What's the lowest cash-on-cash return you'll accept? What's your bottom line goal for internal rate of return, your IRR? And what is the absolute minimum cap rate a transaction must have before you will even consider it? Write these down. These are your hard filters. If a transaction cannot pass these in a simple back-of-the-envelope calculation, you're out of there. This keeps you from hurling dozens of hours of intense due diligence at a deal that never stood any chance of working out for you to start with. It's the ultimate defense against emotional investing. All apartment buildings are not created equal, and you need to know what type you're looking for. There are 4 broad strategies. First, there is core. That's the well-located, unexciting, high-quality building. It's low leverage, low risk, and it's all about stable yield and preserving your capital. Then there's the most common for active investors, value add. That's where you find a distressed, underperforming property. You tighten up the management, and you drive the appreciation by dramatically increasing the net operating income. Second is core plus. It's the older brother of core that needs a little help. It takes less fixes, has a bit more risk, and gives you returns from stable cash flow with some appreciation. And last but not least, opportunistic. That's the high-risk game, ground-up construction, or a very distressed property. It takes massive capital and serious expertise. For most of us, we're aiming for value add and core plus. This is a vital connection that so many new investors take for granted. Your strategy dictates precisely how you'll finance the property. If you're buying a core property with strong income, lenders drool over that. You'll likely qualify for low-rate, long-term, non-recourse Fannie Mae or Freddie Mac, our definition of agency debt. But if you're doing a value-add transaction, the property's income is in the tank, isn't it? That's a risk for the lender's benefit, so they're not going to lend you that nice permanent financing at the beginning. What you do instead is start out with that high-cost, short-term bridge loan. You finance your renovations with that loan, get the property up to a solid level, and then, when there's more income coming in, refinance into that permanent low-rate agency debt. Your initial strategy choice defines your entire time period, your structure of capital, and your rate of interest risk. You've heard it a million times. Location, location, location. But what does that actually mean for an analyst? First, the macro market. You're looking at the big picture. What are the local job and population trends? What is zoning? What are vacancy rates in the entire area? Look very closely for overbought markets where there is very tight supply that has driven prices into the stratosphere. So you have to make some crazy rent growth assumptions to make the math work. Next, you drill down to the submarket. How functional is this specific neighborhood? Is it close to major employers? Is there good transportation? Are there parks and shops like people want? And beneath all of this is the intrinsic value of the land and the stability of the area. This is your safety net long-term. A good location is a hedge against operational mistakes and economic ups and downs. Okay, you've got a property that seems like it could fit your strategy and market. Now go ahead and give it a quick sniff to determine if you're even going to waste time on it. Step 1. Inspect the fundamentals. Square footage, size, number of units. Remember that more units generally provide better economies of scale with your fixed costs. Step 2. Get the trailing 12-month financial statement, the T12, and the offering memorandum. Your first task is to normalize these numbers. That is, Remove any non-recurring expense or revenue that don't reflect normal operation of the building. Step 3. Compute the greatest of all computations, the cap rate. Divide your normalized net operating income by the asking price. If it's lower than the market average, or better yet, your own personal minimum, you're done. Don't make the sale. Abandon the deal. This is maybe the most powerful but least recognized theory in real estate investing, the replacement cost test. You have to ask yourself, what would it be worth to rebuild this very building from the ground up on this same land today? That reconstruction cost is the ultimate long-term floor value for that property. So if your price you paid is at, heaven forbid, higher than that replacement cost, then you have no margin of safety. Think about it. In the event of a catastrophe, in the event of a massive market crash, any funds you've invested above that replacement cost are lost, are gone, are vanished. It's not recoverable. To be a good investor, your price you buy for has to be significantly below the replacement cost. That discount is your cushion for unexpected costs and market movements. Now, let's say the deal has passed your initial screen tests. You go to work, tough due diligence. This is where you become forensic accountant and building inspector. You need to pull a certain set of documents. For the financials, that would be the T12, a fully detailed rent roll and the seller's personal financial statements. For the physical and legal side, you need a professional property condition assessment, zoning reports, environmental surveys, and tenant estoppel certificates, which are just legal declarations from the tenants on their lease terms. These reports aren't paperwork, however. They're the foundation you'll work from to build your own financial model and uncover the true story of the property. And speaking of uncovering the true story, the rent roll is quite possibly the most important document you'll ever get. This is your treasure map for understanding the income. First, perform a rent discrepancy analysis. Compare tenants' actual payments to the confirmed market rent for similar units. A significant discrepancy, known as loss to lease, can be upside opportunity for you. Or it can be an indication that the seller has overestimated what the market will bear. Next, look for concessions. Was free rent for 1 or 2 months included so that someone would come in the door? You need to capitalize that free rent over the length of the lease so you can ascertain the effective rent they're really making. Sellers use this trick to list a high market rent on paper, but really make much less. And finally, check the lease expirations. If a majority of leases are all set to expire shortly after you take over, that's a big risk. You're going to have loads of vacant units all at once, which translates into enormous, unfunded turn costs to get them re-rented. And then there's the building itself. You have to dig past the fresh paint and investigate the innards of the building. Emphasize the most important building systems. The windows and insulation, how good they are. The piping and wiring, how they're holding up. The age of the HVAC system, and how sound the roof is. These will have a direct impact on your utility bills and repair invoices in the future. This is where you trip on the deferred maintenance trap. All those repair expenses you notice up front aren't long-term value-add investments. They are a direct depreciation of the asset's worth, and you need to subtract those costs from what you want to pay. An ancient, inefficient piece of equipment in a building will have long-term, high expense profiles, which leaves you with long-term low net income and long-term depressed ultimate worth of the asset. Time to create your own financial model, your pro forma, your vision of the future, and it needs to be based on reality, not hope. The worst red flag here? Unrealistic rental growth. Your projections need to be linked to recorded historical trends for that particular submarket, not optimistic speculation. Then project a normalized vacancy rate. Don't just copy the artificially low number from the seller. Use a reasonable rate that anticipates normal turnover. And if this is a value-add deal, project even higher vacancy during the renovation period. And on ancillary income like parking or laundry, be conservative. These income streams are often flighty and will fluctuate wildly when you take over. If there's one place deals go to die, it's in the expenses. Underestimating operating expenses is the most common and costly mistake. You can't just take the T12 numbers at face value. You need to normalize every single line item aggressively. 2 big ones to watch out for. First, property taxes. When you buy the property, the tax authority will revalue the property according to your new, higher purchase price. If you don't tie your taxes to the price you paid, you'll be looking at tens of thousands of dollars of unexpected expense every single year. Second, management fees. If the seller's doing it in-house, the T12 might contain little to no management fee, but you need to model a reasonable third-party fee, normally between 4 and 8% of income. If you don't, you're completely underestimating the real cost of running the property. Okay, let's get real here. Here's a quick expense validation checklist. For property taxes, your pro forma will be higher than the T12 based on the new purchase price. For insurance, get a quote with new ownership and status. For management fees, if 0 in T12, you must place that 4 to 8%. For utilities, adjust the historic average based on the building system quality that you've noted in the physical inspection. And for repairs and maintenance, you need to add budget for the deferred maintenance and turnover costs that you've outlined. That's how you build a bulletproof expense model. And then there is the key to it all, net operating income, or NOI. This one's a piece of cake, gross income minus operating expenses. This is the amount that drives the entire valuation of the asset with the cap rate. But under NOI, you have a prominent line item, CapEx reserves. It's not an expensive operation, but it's critical. This is cash you set aside every year to cover the big-ticket future replacements. The roof, the air conditioning, the paving. The price is anywhere from $200 to $400 per unit annually. And let's have a large warning here. If you ignore this or rationalize it so the cash flow looks better, you're fooling yourself. You're essentially arranging for yourself an ambush down the line where you're going to have a gigantic, unexpected bill all at once. Now, the 3 key numbers that tell you if this deal is a success or not. Number 1, the capitalization rate or cap rate. This is your unlevered snapshot of return at purchase. Number 2, cash-on-cash return. This is your annual pre-tax cash flow divided by all the cash you've invested. It's your top-line number for cash flow, and it's highly responsive to your finance, your leverage, and your interest rate. And third, the whopper one, internal rate of return or IRR. This is a time-weighted measure that adds up all the cash flows over the life of the investment, including the whopper payday when you sell. It's the ultimate measure of your total return. I need to interrupt on the IRR for a minute because this is where investors get fooled, typically by themselves. Your IRR is based a great deal on your projected sale price, and that sale price is found by dividing your projected future NOI by an assumed exit cap rate. The typical fallacy is to use an unrealistically low exit cap rate in order to make the IRR sound wonderful. For example, buying on a 6% cap, but assuming you'll sell on a 5% cap. That is artificial appreciation in price based only on future market conditions being perfect. The professional move is to be conservative. Take your exit cap rate to be 50 to 100 basis points higher than your purchasing cap rate. This gives you a worst case, a floor on your return, and protects you from a falling market. Good. Brief slide on your funding options. For stabilized core characteristics, you require agency debt from Fannie or Freddie. It's low cost, long-term, and non-recourse. For value add, you're referring to bridge loans. They close fast, but have high and usually variable interest rates, and usually personal recourse is involved. For smaller deals, you might use a conventional bank loan, which is often relationship-based but is recourse. And for large, long-term transactions, there are non-recourse CMBS loans with very tight terms and ugly prepayment penalties. Your choice here governs your cost, your risk, and your cash flow. All right, now let's run through a brief list of red flags. Run if you see these. Unrealistic pro forma assumptions. Too high rent growth, super low vacancy, no CapEx reserves. Cost disparities. If the cost of operations looks way too low compared to industry norms, something is being hidden. Exaggerated rents in the marketplace. Always verify with your own independent market study. Low repair prices. Never accept one contractor's bid. Get several and include a 15% contingency factor. Purchasing at or close to replacement cost. We just covered this. It means no room for mistake. And finally, but not most importantly, sponsor risk. If the deal leader is inexperienced, he or she may not be capable of executing the plan, and there will be delays, cost overruns, and requests for more cash from you. You've built your model. You now have to try to break it. This is called stress testing. First, the interest rate shock. Suppose your cost of debt goes up by 1 or 2%. Can you still afford it, especially with a variable rate bridge loan? Second, an occupancy crisis. Simulate what if your occupancy is 5 to 10% below your goal. Calculate the break-even point at which the property no longer produces cash. And third, the exit cap stress. Recalculate your IRR based on that higher, more conservative exit cap rate we've talked about. That shows you your actual worst-case return. Stress testing is not pessimism. It's being prepared. It tells you exactly how much buffer capital you need in order to be safe. You've made it. Time for the final decision. Compare your stress-tested IRR and COC numbers to the goals you set at the very beginning. If the question only works in the best possible scenario, but blows up under stress, you have to reject it. Have the willpower to walk away. Successful underwriting is when your qualifications are satisfied even when you are factoring in volatility. And if the transaction is a go, your financial model never gets stashed away. It becomes your operating guide. Your CapEx plan is now your to-do list schedule. You now operate the asset against the conservative assumptions you made during the acquisition. The moral of the story is that multifamily deal analysis is actually a science of capital preservation. It's a science of doubt-based thought. The greatest tragedies come from hyping the income and minimizing the expenses. By placing stress testing first and testing whether your deal will perform in bad times, you build a robust, wealth-generating investment. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.